All right, I think we're being, yeah, awesome. So firstly, we'll be speaking about the two accounting standards. So the first of them is IFRS. It's called the International Financial Reporting Standards. And the second one is GAAP, which is also known as US GAAP. So as you can see on the screen, the US GAAP refers to the generally accepted accounting principles, and it's a framework of accounting guidelines or accounting framework set or laid out by the Financial Accounting Standards Board, which is also known as the FASB. So if you are reading some article on Wall Street Journal, you would some of the times see that the FASB responded to some like event in the markets through some new accounting guideline. So the FASB is the board that sets out the guidelines, and the framework or the set of guidelines is known as the US GAAP. So in the US, of course, we use the US GAAP, but in most of the other parts of the world, we use the International Financial Reporting Standards, which is laid out by the International Accounting Standards Board. So this just helps maintain consistency across the financial reporting of the companies, because otherwise every company would have their own rules and regulations as to how they actually lay out the financial reporting or the financial statements of their own company. So if you want to compare two companies or the financial health of two or more companies, it is generally recommended that there's a consistent standard that both of them report their financial statements with regards to. And the US GAAP is that standard for the US, and the IFRS is that standard for the rest of the world. It might seem weird that US has a completely different set of guidelines as opposed to the rest of the world, but I think most of us are familiar with how the US has a separate system for basically everything, miles versus kilometers and all that debate. Um, so we'll be looking at the gap mostly because we will be looking at the companies in the US. And there has been progress in terms of converging the gap and IFRS. So there remains only like one universal standard, but the progress has been kind of slow. So maybe in the next 5 to 10 years, we might see a little more progress towards making one universal set of accounting standards. And there is not a lot of difference between IFRS and GAAP. Some of the main differences are like maybe in how you account for inventory or how you account for tax and everything. But for this session or for your career, maybe in investment banking or whatever, you don't really need to know what the differences are. But if you're curious as to how they do differ, I would recommend you to just Google what are the differences between IFRS and GAAP. But I just want to make sure you are familiar with these terms. And GAAP is what we will be looking at in this session. All right. So the most fundamental concept in accounting is the concept of accrual accounting. And accrual accounting is what we use in the US GAAP as well. So there are basically two methods to account for the financial health of the company. There's accrual accounting and there's cash accounting. So the cash accounting seems more intuitive, and it recognizes revenues and expenses when cash actually exchanges hands, which makes sense to most of us because that's how we also account for the financial transactions that we do. But accrual accounting is what every company uses because it's the standard set by GAAP, and every public company needs to adhere to the GAAP principles. And again, the private companies can report their financial statements, however, because there's like no obligation on them by the Security Exchange Commission, which is the SEC. But when the company goes public, every company needs to maintain to a set of standards set by the FASB and SEC. So all of those companies report their financial statements adhering to the principle of accrual accounting. So it is really important to understand what accrual accounting is. So the accrual accounting basically records revenues and expenses when a transaction happens actually, rather than when the payment is received or made. So this could be both at the same time, but this could also vary as well. So one of the examples of accrual accounting could be, for example, in January, I buy a bag of chips from Walmart. for $5, and I paid through my credit card. And yeah, so I paid through my credit card, and the credit payment needs 7 days to process, for example. It is a long time, but just for the sake of example. So I bought the item from Walmart. They would record their $5 the same day, because it was earned the same day, but even though they haven't gotten the money for that yet. So there's a lag of 7 days between when the transaction actually happened and when they received the money. So if you see in any income statement or any cash flow state in any income statement, all of the revenues and all of the expenses that are recorded there are recorded under the assumption of accrual accounting. So the revenues, maybe a company has $100,000 of revenues in Q1 of 2020. So from January to March or January to April, the company recorded revenues of $100,000. This does not mean that the company actually has $100,000 of cash in their bank account, neglecting all the expenses, because it is not necessary that the company actually received all those $100 in cash, because we're operating under the assumption of accrual accounting. So some of that might be cash, and some of that might go to another account that we'll be looking later. So because of the accrual accounting, it results in many different accounts generated on the balance sheet. And we'll be looking at all those accounts in detail as we move to the balance sheet. So it is because of accrual accounting that we have all those non-cash accounts generated on the financial statements. And there are like a few different benefits of accrual accounting over cash accounting. So the accrual accounting is, I think, more, it makes more sense when you actually want to assess how the company did in a certain financial quarter. So for example, the company made revenues of $150,000 in Q1, but it actually only made a revenue of $50,000. Yeah, so I just got a question. Is this the accounts payable section in the balance sheet? So the accounts payable and the accounts receivable are accounts generated on the balance sheet because we are operating under the assumption of accrual accounting. And I'll be speaking more about what accounts receivable and what accounts payable are as we talk about the balance sheet. So just one main difference or one main benefit of accrual accounting over cash accounting is it gives a clearer picture of what the revenues and expenses were in a certain quarter, regardless of whether the cash was received or not. So if you're making high revenues in Q1, it means that the company was operating really well in Q1, regardless of whether you got the cash or not. Because whether you got the cash or not is actually depending on the customers and how much time they're taking to actually pay what they bought from the company because of credit card or whatever. But it actually gives a clearer picture of how the company did in a certain financial period. And one of the main benefits of cash accounting over accrual accounting, which is a negative or a con of accrual accounting, is that the cash accounting gives a clearer picture of the cash flow of the company because it's just reporting or accounting for when the cash actually exchanged hands. So the company might, record revenues of $1 million, but actually go bankrupt because none of those nothing was actually received in cash, and a lot more was spent in expenses. So while accrual accounting, gives a clear picture of the operations of the company, cash accounting gives a more clear idea of how the company is doing in terms of the cash flow. And cash flow is really important when we are looking at the value of the company or when the investors are assessing how much return they would make or how attractive that investment is. And one main principle that we used in accrual accounting is that revenues and expenses are recognized in the same period. So what this means is, for example, you bought some inventory to sell off in January. So you paid maybe $500 to the supplier that you bought the inventory from. This $500 would not be accounted in the income statement until you actually make revenue from this $500. So when you make revenue from something, some asset, then you actually recognize the expense for that asset. So if you bought this $500 in January, but you sold off this inventory in March, March is when you would make revenues out of this inventory, and March is when you would also recognize the expenses for this inventory because, excuse me, because expenses are only recognized when there's an associated revenue coming out of it. So you would not account for expenses unless you're actually, you have a matching revenue. So this is what the matching principle states. Okay, so there are three main financial statements that we'll be looking at, and what basically form the foundation of any company's financial statements. So the first one is the income statement. It is also known as the statement of operations or the statement of profit and loss. And it reports a company's financial performance over a specific accounting period. So there are three statements, the income statement and the cash flow statement. They both reflect the company's financial performance over a specific accounting period, as opposed to balance sheet, which is just a snapshot of a company's financial health at a certain point in time. So the balance sheet is not over a period of time, whereas the income statement and the cash flow statement are over a certain period of time. An income statement is very critical for investors to analyze the operations of the company, because the operations are actually the core of any company. So they really look at the income statement when they want to analyze how profitable the business is. And again, the revenues and the expenses that are recognized in the income statement can be non-cash because of accrual accounting. But it just is a picture of how profitable the company is in terms of its operations. So as you can see, the last point is the profit on the income statement. Sorry, the profit on the income statement is not necessarily equal to the cash flow because of accrual accounting. So I just got a question. So does the income statement only utilize accrual accounting? So every financial statement of any company that adheres to GAAP, which is basically all the public companies, they would all utilize accrual accounting. So that is the reason we have the income statement. And then we have another statement called the cash flow statement, because the cash flow statement gives how much cash actually exchanged hands, whereas the income statement is just accrual accounting. So that's why we don't have just one single statement, because it's the same thing that's written on both the income statement and the cash flow statement, but there's a need for these two different statements, because the cash flow statement just gives you how much cash was, what the cash inflow was, or what the cash outflow was. But the income statement gives you a picture of the company's operation adhering to the accrual accounting principles. So it's not necessarily equal to, the cash flow of the company. Any questions so far? I'll wait for 10 seconds. And since I saw that most of you are not really familiar with, how the accounting works, so I'd appreciate if you, ask any question at any point in time, no matter how basic it is. I'm happy to, go over anything again. Any questions so far? Nothing. Okay. So the next statement that we'll be looking at is the balance sheet. So the balance sheet is a snapshot of the company's financial health. So it is not over a period of time, which is contrary to the income statement and the cash flow statement. So that's why we usually have two balance sheets for a period of time, the beginning balance sheet and the ending balance sheet, because it's just a snapshot of where the company stands at a given day or given day of the year, a given point in time. And more precisely, it reports the company's assets, and the assets is what the company owns, of course, and the company's liabilities, which is what it owes, and the shareholders' equity, which is what the company's worth after all the liabilities are paid off. So if all of these terms are, alien to you so far, don't worry, because we'll be looking at all of those in detail as we move to Excel to actually build out a balance sheet. Okay, so the assets, this is a fundamental identity or equation for accounting, which is that the assets are equal to liabilities plus shareholders' equity. So if anyone asks you for, what's the accounting equation, or what's, the equation for the balance sheet, this is the equation that that they'll be looking for, and you will tell them that the assets are equal to the liabilities and the shareholders' equity. Now, why this equation holds, or why this is the way it is, we'll be looking at later when we actually look at the balance sheet in more detail. So both the assets and liabilities are divided into current and non-current. So the current assets are basically all the assets that can be converted to cash within the time of a year. So some of the examples are cash, accounts receivable, and inventory. Accounts receivable we have not looked at yet, so I'll leave that for later. But the cash is the most liquid asset. So what liquidity is, that how easy it is to convert an asset to cash. So if we say that inventory is very liquid, it is because we can just sell off the inventory tomorrow and convert that to cash. Again, it differs from company to company as to how easy it is to convert the inventory to cash. But inventory is usually considered liquid, whereas, for example, a large factory would be considered illiquid because it is not very easy to sell off the factory in a short period of time. So current assets are assets that can be converted to cash within a year's time, and non-current assets are assets which you can derive value out of beyond a year in time. For example, a company or some machinery that you have, mostly it's the land that you own. For example, the machinery and the buildings and the factories are all accounted for under an account called the property, plant, and equipment, which is also referred to as the PP&E. So that's non-current asset, and current assets are, again, as I said, the assets that you can derive value out of only for a year's time. Liabilities, again, the current and non-current division. So the current, when you hear the word current, you should think of a year. So the current liabilities are what you owe within a year's time. So for example, accounts payable, or any debt that you have, which has a due date this year, that'll be your current liability. Whereas non-current liabilities is what you owe, or what you owe to someone, not this year, but beyond this certain financial year. So for example, any long-term debt that you have, or any other long-term liabilities. Yeah, so someone asked me to explain non-current assets again. So non-current assets, you can look at it two ways. So either non-current assets are assets that you cannot convert to cash within a year's time, but the more appropriate, or the more accepted definition is non-current assets are assets which you can utilize or you can derive value out of. And when I say value, it's like revenues, of course, or that helps your company generate revenues. So all like the same things, but phrased in different ways beyond a year's time. So if you have a factory, for example, or more simply, if you have a certain piece of machinery, and the machinery has a life of 5 years, so you can use that machine for 5 years to generate revenues for your company. So it'll be a non-current asset. So someone asked, would a non-current asset be a bond? Would be something like a bond that the company has bought. So bonds are bonds are basically a form of debt that you give someone, and they give you interest payments. So non-current assets, so interest payments can be non-current or can be current. Usually we don't account for bonds on the balance sheet. It's recorded under other income or other expenses on the income statement. So the bond can be accounted for as a non-current asset, but its value would be depreciated. So it's like complex because as the bond gets closer to maturity, its value decreases because of the return that you would make if you buy the bond 5 years from now as opposed to 3 years from now. So when I think of when I say of non-current assets, you shouldn't be thinking too much about bonds, but more about the machinery or the factory or the land that a company has. And also non-current asset could be intangible as well. So it could be patents, trademarks, or copyrights that a company has, because if you have a copyright for a certain product, that copyright would give you a value beyond the year in time, unless unless it's expiring within this year. So the physical. Yeah, exactly. So not too much physical because whereas it's physical, but physical could also be current. So when I say non-current, of course, it can be physical and non-physical, but you should be thinking about the time period. So if it gives you value beyond a year, it's beyond this year, it's non-current, and if it gives you value only this year because it's expiring or it'll run out or you'll sell this off or whatever, it's current. And when I say about the intangibles, so it could be trademarks, patents, copyrights, goodwill, brand value. All those are accounted for in the non-current assets. Brand value is mostly accounted for under the goodwill. So I'll be explaining goodwill later when we actually look at the balance sheet. And then the equity part. So the equity is basically what the company's worth after all the liabilities are paid off. So if you rearrange this equation a bit, you'll see assets minus liabilities is equal to shareholders' equity. So the shareholders are basically all the people who have an ownership stake in the company. You can get this ownership stake either because you founded the company or that you bought the shares of the company. So the shares are basically, if a company is worth $100, you can divide that company into 100 parts and sell each part for $1. So that one part would be a share, and that'll give you an ownership stake in the company. And what your ownership stake would be is determined by what remains after liabilities are paid off. So the assets minus liabilities is what the company is worth. And the shareholders' equity is divided into two accounts. It could be stock or it could be retained earnings. And I'll be looking at both of them later when we actually look at the balance sheet. Any questions so far? Again, as I said, it is all new to you. So if I'm going over something too fast or if you still have questions, you can feel free to ask it as many times as you want. Because I want to make sure this is the most helpful to you. Any questions so far? All good? All right. So the third financial statement is the cash flow statement. So it gives you a picture of what the sources and uses of cash for a business are. So in basic terms, just cash inflow and cash outflow, how much cash is coming into business and how much cash is actually going out of the business. So a very important interview question that comes out of the cash flow statement is, what if you only had two financial statements? Which two financial statements would you have if you just had the option to look at two to assess the company? You would always go for income statement and balance sheet because the cash flow statement can be derived out of the income statement and balance sheet. So it is not necessary to have the cash flow statement at hand to actually assess the cash inflows and outflows. If you have the income statement and if you have the balance sheet, you can actually derive the cash flow statement. And how that works is, so the income statement adheres to the principles of accrual accounting, which is basically you would not, it'll just recognize revenue and expenses when they incur. But the balance sheet would give you a picture of what accounts are generated because of accrual accounting. So for example, if the revenue is $100, 50 of that was earned in cash, 50 of that was not, for that 50, the cash was not actually paid. So the balance sheet would tell you hey, the $50 are still outstanding. So if you have that income statement for $100. And if you have the balance sheet, you can just use both those to actually see how much cash came in. So if the income statement told you that you earned a revenue of $100, but the balance sheet told you, well, like, wait, the $50 of those $100 are not actually earned in cash. So you can, do the math to actually see that only the rest of the 50 was actually coming in as cash. So you can use the income statement and the balance sheet to actually draw out the cash flow statement. So the cash flow statement is divided into three categories: the operating cash flow, the investing cash flow, and the financing cash flow. So the operating cash flow is basically this includes all the items that are found on the income statement, such as revenues and operating expenses. So it is the cash flow that's generated from just the operations, the core operations of the company. So not really investing or not really financing. So the operations are basically what the business is about. So if the business is maybe like a grocery store, so if you're taking in an inventory, if you're buying inventory, that'll be a cash outflow. And if you're selling that inventory off, that'll be a cash inflow. And because that's the core operation of the business, that you just buy some stuff and you sell that stuff out to consumers, all that expenses would be accounted for under the operating cash flow, because that's what the core operation of the business is. And now the investing cash flow is basically all the cash flow. The cash flow could be inflow or outflow, and this accounts for any purchases for the long-term assets, such as property, plant, and equipment, or selling those long-term assets as well. That'll result in a cash inflow, or you could be making investments in other businesses, or acquiring businesses as well. So if you made a purchase of like a piece of land, or another shop, so that shop is not really a core part of your business as yet, because you haven't really started selling inventory off in that shop. So that purchase would be accounted for under the investing cash flow. So if that shop is up and running a year from now, and all those all the revenues that would be earned by that shop would go under the operating cash flow. So if you make any investments, or if you sell any investments off, both of those are accounted for in the investing cash flow, given that the cash is actually exchanging hands. So the financing cash flow looks at two main categories: either the issuing or repurchasing of shares, or the raising or repayments of debt. And when I say shares, it also accounts for the dividends as well. So if you issued shares, which means that you're selling shares of your company to someone, you're getting money, because, as I said, if the company is worth $100 and you divide it into 100 parts, now I need some money to actually operate my business. I can either get it two ways. So I need some money for my business is called capital raising. So when you hear the term, I need to raise some capital, maybe in Shark Tank or something, they're basically saying that I need some more money to actually run my business for whatever reason, maybe marketing or the core operations. The money can be raised two ways, either through equity or debt. Debt is basically when someone gives you a loan and you have to pay it back with some certain interest that you agree upon. But the equity is when you actually give out a part of your company, and you don't for some money. For example, if my company is worth $100, and I say I need $10 more for running my business, I can like ask any of you to give me that $10 and as a debt, and I keep all of my company as it is, or I can ask I can ask any one of you to give me $10 in return for 10% of my company. And if the company is valued at $100 million 10 years from now, your ownership stake would still be 10%. So that's an incentive to actually buy equity into a company, because as the company grows, the value that you hold for the company is actually growing as well. So another interview question is like, why you should go for equity, why you should go for debt. So I'll recommend you all to actually look more into that. I can explain like the differences now as well, but we only have 20 minutes or so, and I'm actually wanting to go into the financial statements a bit more. But this is a very important question. that, why raise equity or why raise debt, because you're still like getting $10. So what difference that makes. But if you actually know that, your company has growth potential and your company would, grow to $1 million valuation, 5 years from now, it is not the best idea to give out 10% of that company. Whereas if your company is not cash rich, and you think that, you would not be able to make the debt payment, it is a good idea to, sell off equity in the beginning. So now we'll be looking at how the income statement, cash flow statement, and balance sheet are actually created. So I'll be sharing an Excel document with you. Okay, any questions so far? I'll take a break of 1 minute here. And equity is shares, basically. Someone asked that question. Is everyone with me, or is everyone kind of lost?
It's really good so far. Thank you.
Okay, awesome. All right, so the core, or one of the most basic skills that you should have when it comes to finance, is to actually be able to construct an income statement, balance sheet, and cash flow statement. And then the second skill that you should have is to actually analyze what the story and income statement is telling you, or what the story, balance sheet, and cash flow statement is telling you. So we'll cover the first part of actually creating those statements today. And on next Saturday, we'll be actually analyzing the income statement. And that involves the use of ratios and everything. But that's a little more advanced topic. The first thing that we need to cover is to actually how to create an income statement and what the basic line items are. All right. So we'll start with the income statement. And you should all be very comfortable with actually, creating an income statement, creating a balance sheet. So it shouldn't be something that's, that should take you too long after you get some practice with it. So after today's session, I would recommend that you all go back and you all, try to make up some revenue, some income statement, given that, you have some revenue numbers and stuff like that. But the first thing that you should know is the order, the order of line items on the income statement, balance sheet, and cash flow statement. So we'll start with the income statement right now. So the first line item on the income statement is revenues. So revenues is pretty self-explanatory. That your sales or the money that you're making from whatever your business is. So for a grocery store, it'll be whatever sales the grocery store has for that period of time. Because as I said, the income statement is for a period of time. So it could be a quarter, or it could be a financial year. So an entire year. So revenues is the first item on the income statement. It is also referred to as top line. So for anyone who watches Shark Tank, when they say what the top line is, they're referring to the revenues, and that's why it's known as the top line, because it's the first line on the income statement. The second thing is the cost of goods sold. So the cost of goods sold are basically the direct expenses associated with the revenues. So the main component of the COGS is the inventory costs. For example, if in the case of a grocery store, it'll be whatever your expenses was actually buying that inventory. So if I'm a shop owner and some factory is giving me 10 cans of soda to actually sell out to the consumer, whatever I paid for that 10 cans of soda is my cost of goods sold. And whatever money I make selling those 10 cans of soda is what my revenues are. So it is, again, the direct costs associated with revenues. So the first component is, again, as I said, the inventory, but the second could be direct labor. So when you hear where the labor cost should be accounted for, most of the times it's not COGS, because the labor could be, if it's a company and it's the salaries of the people who sit in the office or whatever. They're not directly involved with the manufacturing of the product. And the people who are actually directly involved are people on the assembly line, or the people who, who are actually operating the machinery and stuff. So for most part, the salaries would not be COGS, but there are certain people who are, directly involved with the production of the product, and their salaries would be accounted for under COGS as well. And that gives us the first net total, which is the gross profit. So the gross profit is what the revenues are less any COGS. So the gross profit is revenues minus COGS. Okay, so the next thing is any operating expenses. So the operating expenses is whatever the company needs to spend for the operations of a company. So it could be any marketing expenses, it could be any distribution expenses, it could be any research and development expenses. So all these are operating expenses. These are all accounted for under a category called the SG&A. You might have heard this term before. So it's called the selling, general, and administrative expenses. So all these expenses are accounted for under the SG&A. So then it gives us the EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. I haven't spoken about depreciation yet, but it's coming just now. So if you, the EBITDA is basically the gross profit minus the SG&A. Just got a question. Yeah, exactly. So the operating expenses is the SG&A. Yeah. So the EBITDA is the gross profit minus the SG&A. And then we account for any depreciation, amortization. So what these two terms mean. So as I said, we are looking at accrual accounting. So this is another, horror of accrual accounting that we have to face. So if I bought some piece of equipment for $1,000 right now, and that piece of equipment would actually help me generate revenues for the next 5 years. So as I told you about the matching principle, so the expenses would only be recognized when associated revenue is generated. So if I'm generating, I bought the machine for $100. It's lasting 5 years. And if I'm generating, equal revenues throughout those 5 years, I would only recognize $20 of that in the first year, and then I would only recognize $20 in the next year. So basically, the cost is spread out over the useful life. So the formula of depreciation is it's the value divided by the useful life. And we're using straight line depreciation here. And this is what many companies use. So you just take the value of the asset or any factory that you bought or any piece of equipment, and you divide it by the useful life. And you have to recognize the depreciation expense each year. Because as I said, the expense cannot be recognized until the revenue is generated. So you cannot recognize the $100 in expense. It's only the first year because you haven't generated everything that you can out of that piece of machinery in the first year. It still has a life of 4 more years. So that's how it works. So and it's also meant like the wear and tear on the machine. So the value of the machine is only the value of the machine decreases as you work on it, because a value of the machine that you bought right now and the value of the machine 2 years from now is actually different, because 2 years from now it would have some wear and tear and stuff like that. So that also is given by the depreciation. And amortization is the same concept, but for intangible assets. So for example, you recognized some brand value that you had of $500, that my brand name or my brand recognition of is $500. But then 2 months from now, your company was involved in some scandal or something, so that your brand value is actually decreased. So that would go under the amortization. And amortization is more of like a regular depreciation of intangible assets. So if you have copyright that's valid for 5 years, and you purchase that copyright for for $100, it'll be the same story as if you bought a machine for $100. The $20 would be deducted every year. So then we have the EBIT. So the EBITDA minus, so the EBIT is also known as the operating income. And mostly you would not see EBITDA written on the financial statements, it's only the EBIT. But you can go elsewhere in the financial statements to actually look for the depreciation and amortization to calculate the EBITDA as well. So this is the earnings before interest and taxes. So it's not a surprise that what's coming after is the interest and taxes. So the interest expense or income. So mostly it's interest expense because your company, borrowed some debt and you need to make interest payments on it. But it could also be interest income. As someone mentioned, bonds. So if you have given, if you have a bond, you would earn interest on it, and that interest would actually be accounted for here. So whoever had the bond question, the interest income is actually accounted for here. So then we get to the EBIT, the EBT, which is the earnings before taxes. So the earnings before taxes is just the EBIT minus interest expense or interest income. And then we have taxes. And then we have the net income. So net income is just the EBT minus taxes. Sorry. And this is known as the bottom line of the income statement, or just like, whenever someone says the bottom line, they're referring to the net income. Any questions so far? At this point, you can just mute yourself because I'm taking a break.
Yeah, so what is IE and II is interest expense and interest income, right?
Yeah. Mm-hmm.
Okay. And SG and A would account for stuff like back-end office workers, right? You said COGS doesn't account for people that work in the office that are not directly like related to revenue generation immediately,
Mm-hmm.
right? For like marketing and stuff, right?
Exactly.
Okay, but you don't have, do you have separate rows for marketing, distribution, and R&D, or is it all just in the SG&A?
It's all under the SG&A because
Okay.
it differs from company to company. Some company might not spend a lot in marketing, so they don't really need a separate line item. And the expenses could be marketing, distribution, R&D, and there could be, a ton of other expenses depending on what the company actually does. And that all goes under the SG&A. So you would just see a line item for the SG&A. Any other question?
So is the operating income the same as EBIT?
Yes.
Okay.
They just have.
And then what? Sorry, this is kind of going back to like above.
No.
What is SG&A stand for?
It stands for the selling, general, and administrative expenses. It's just the name given to all these expenses. The marketing, the distribution, the office work, the receptionist and stuff like that. Any other question? We might run a little over, so if you have to leave like at 1 sharp, feel free to do so, and you can watch the recording later. So we're good? I'm speaking for too long. Okay, so the second is the balance sheet. So the equation that I told you was the assets equal to liabilities plus shareholders equity. Okay, so firstly we'll look at the assets, and those are converted into, I forgot the shortcut for current and non-current. So the current assets, the first one is always cash because it's the most liquid. And again, if you forgot what current and non-current meant, just like shoot me a text. And the second one is inventory. Second one is actually, inventory. And then we have the accounts receivable. And we have other current assets as well, for example, like marketable securities or money market instruments and stuff like that. But that's not really necessary to know about right now because that's a little more advanced. So you should be thinking about these three main accounts when you think about the current assets. And now I'd like to explain what accounts receivable and accounts payable is. So if I'm a company, I'm the owner of the company, and I could pick, so the Max is the first one on my screen. Max is the supplier of goods to me, so the company, and the second one is Grant. So Grant is the consumer. So if I'm taking some goods from Max, who's the supplier, and selling them off to Grant, I'm making a profit, of course. So if Max sells me some product for $100, there are two ways I can go about it. Either I can pay Max the $100 straight away, and they're like we'll be all good. But the second thing is usually what happens most of the times is you don't really pay cash upfront, but there are like certain terms or contracts that are drawn out between the suppliers and the company. So I could tell Max, I could pay you $50, I could pay you $60 right now, and I could pay the rest of the 40 a year from now. So that rest of the 40 a month from now, a year from now, is what we call the accounts payable. So the accounts payable is the money that wasn't paid out in cash to Max or the supplier, basically, from the company. But I would still recognize that expense when I make revenue out of that, because that's what I have to do under accrual accounting. Because we're not looking at cash under accrual accounting, we're just looking at when the transaction happened. Okay, so the second thing is, so the Grant is the consumer. So I sell that $100 of goods for $200 to Grant, and Grant tells me that he spent all the money that he had last night at Jug. So he could give me $20 right now and 180, a year from now. So the year from now, the $180 that he has to give me is the accounts receivable. So the accounts receivable and accounts payable, they're both with regards to the company. So accounts payable is the payment I have to make to Max or the supplier, and the accounts receivable is what I have to receive from the consumer, but hasn't been received yet in cash. But I still recognize it because I actually made that revenue. Make sense? This is very important to understand. Most people confuse it. And it all happens because of accrual accounting. So the accounts payable is whatever remains, just a later cost. Yeah, so the cost of the inventory was $100 that I have to pay to Max, who's the supplier. And that inventory cost is actually divided into cash and accounts payable. So a part of it I can pay to Max right away in terms of with cash, and some of it I can keep for later, and that'll go under my accounts payable. But I'm recognizing all that $100 because I'm actually making revenue out of it. So I do have to recognize it. But just because all of it wasn't paid in cash is what leads to the accounts payable generated. If we were using cash accounting, then the accounts receivable and accounts payable wouldn't be there. Do you recognize inventory in the income statement? Yeah, so the inventory goes under the, actually can someone take a guess where the inventory should go? Anyone can mute themselves. I cannot see. Take a wild guess. Unmute yourself.
EBITDA. EBITDA.
So the inventory is a cost.
Oh, okay, it's a cost.
Yeah, so it's the cost of goods sold. And it's also like in the name. So the cost of the goods that you actually sold is basically the cost of the inventory that you bought. Because the inventory is the goods that you sold. All right. So that's accounts receivable and that's accounts payable. Does anyone have any question on the receivable and payable aspect?
Yeah, are they the combination of, so is inventory just divided into accounts payable and accounts receivable? So is inventory naturally, is it inventory divided into current and non-current, right?
No, so inventory is a current asset, and accounts receivable and accounts payable are accounts generated because we're not talking about cash all the time. We're just talking about revenues and expenses under accrual accounting. So again, I would run the example that, you were the supplier, I was the company. You sold me $100 of goods, or I bought $100 from goods from you, because I'll be talking about with respect to the company. So I paid you $60 upfront, so that goes on, that counts as the cash outflow. But then I said I would pay you $40 later. So that $40 later is the accounts payable from the view of the company.
Right, I understand that, but do they count as current or non-current? The
They're,
payable,
they're both current. They're both current. So accounts
payable and receivable are both current.
yes.
Okay. Thank you.
Accounts. So another thing, accounts receivable is the money that I still need to receive from the consumers. So that's an asset. But the accounts payable is something that I owe to the suppliers. That's a liability. So we'll be talking about liabilities in a bit. So the non-current assets could be PP&E, which is the property, plant, and equipment. Or it could be any maybe value of your factory or something. So anything that gives you value beyond the first year, beyond the year in question, is a non-current asset. It could be intangible as well. So like copyrights and stuff like that. Patents, trademarks. So that gives you the assets, current and non-current. So the liabilities. The first thing is accounts payable. Again, assets is what I own. Liabilities is what I owe. So if I owe some money to the suppliers, that'll be accounts payable, and it's current, because usually I would owe that money like within the year's time. Otherwise, no one would sell any goods to me. So it's a current liability, and then there could be other current liabilities. For example, any short-term debt that I have, or any portion of the long-term debt that is due this year. So anything that's due this year is a current liability, be it accounts payable or any short-term debt that I have to give back within this year, or if the long-term debt has some portion due this year, that's also current. And the non-current could be any long-term debt that I have. So that gives me the total liabilities. The shareholders' equity is basically the difference. If assets is what I own, and liabilities is what I owe, so the difference should be what I actually own after like all the expenses are paid off. So if the company is worth actually, if the company's assets are worth $1 million, but you actually need to make outstanding payments of $500 or $600,000, then the company's actual worth is just $400, because you cannot take all that million home without actually paying the $600,000 that you have to do. So that gives us the actual worth of the company. And it has two accounts: the stock, or also known as the common stock. So there are different classes of stock: common stock, preferred stock, and stuff like that. I'll not be going to that right now because that's a topic for later. And we usually look at common stock. So we got a question. So the market cap is basically the value of the common stock. So shareholders' equity here has two accounts. It has the common stock and it has the retained earnings. So the market cap is basically the value of share and shares outstanding. So that's how market cap is calculated. Shares outstanding means how many shares I've actually issued. So if again my company is worth $100, I have 100 shares. So I've divided the company into 100 parts. And if I issue 10 shares out of it, so 10% of my company I've issued in shares in return for $10, I would say that the shares outstanding is 10.
So where does market cap fall into on the balance sheet?
Market cap doesn't fall
Anywhere.
Yeah, it falls under the common stock basically. But the market cap is the value of the share right now, and what we issued the share at could be different from what the value of the share is right now. And then the retained earnings. So the retained earnings is what earnings that a company retained. So if the company made a net income of $100 in year one, and then no money was taken out as salaries of the company owner or anything, and all that $100 actually went back into the business, that'll be counted for in the retained earnings here. So basically, this retained earnings is linked to net income here. And I'll be going over like how the income statement, how the three financial statements are linked in the following session next week, because that's one of the key questions that we get in interviews and stuff. And it's really important to understand. So the retained earnings account is just the sum of all the net incomes from the past years. And if you have dividends, I want to be more precise with it. So if you have dividends, dividends is so if you bought 10 shares for my company, I'm not paying you any money on those shares because it's not debt, but I can actually pay out some dividends to you as like, a thank you token for keeping my share over someone else's share. And though that, a cent per two is known as dividends. So the retained earnings is precisely any net income minus dividends that you have been earning for the past years. So it's just the accumulative account for all the net incomes minus dividends. So that's what the balance sheet is. And lastly, we'll be going over the cash flow statement. So I can either go over the cash flow statement right now, or we can do it in the beginning of next session, whatever most people vote for. Any suggestions? Spam the chat. This is the moment to spam the chat. You can write R for right now or L for later. Personally, I think it'll be helpful if we go over it right now, so that I can actually give you an exercise later for the week if you want to get some additional practice. Oh right, I think my opinion is the popular opinion. Perfect. So we'll be. I should run for president now. All right. So the cash flow statement. And again, I don't expect you to remember all of this or understand all of this like in the first go, because it's all like new to you. I've spent like a lot of time understanding it, so that's why I do understand it. But for any of you for whom this is like the first introduction to all of this, don't be afraid if you're kind of lost or if you're not understanding every bit that I'm saying. And I'm definitely like available anytime, so you can reach out anytime with questions and stuff. So as I said, it's divided into three sections: cash flow from operating activities, cash flow from investing. What was the third one? Someone could tell me.
Financing.
Perfect. Cash flow from financing. So operating activities is just the core operations of the company. So any revenues that you make would go here. any expenses that you incur would go here. And here in the cash flow statement, we're only looking at the cash expenses and the cash revenues. So if I sold off $100 of goods, but actually received only $60 right now in cash, I would only write a $60 here. But on the income statement, I would write the entire 100 because that's my actual income for this financial year. Any revenues, expenses, any SG&A would also go here. Any other any interest, income, or expense. Interest, income, or interest expense would also go here. So does someone see anything? Maybe have we done all this kind of before? Does it seem that it's like a repetition?
It's
Could go. Yeah, Max.
it's basically the current transactions from the balance sheet, right?
It's everything that we wrote in the income statement.
Right, it's the income
Revenues,
statement.
yeah, expenses. So basically the cash flow from operating activities is just the income statement, but we actually adjust it for any non-cash expenses. So there are two ways to go about the cash flow from operating activities. There's a direct method and there's the indirect method. Got a question, I think. I'm having a hard time opening the chat. Better question. So there's the indirect method and there's the direct method. So most of the companies actually every company uses the indirect method. So the indirect method is just you take the net income from the income statement and you push that here. You take the net income and you adjust for non-cash expenses. So remember I said that you can draw out the cash flow statement from the income statement and balance sheet. So if the income statement is telling you like, hey, you made a revenue of $200, and then the balance sheet, actually a quick question. So if I made a revenue of $200 and the consumers paid me 115 cash, and I'm still waiting to receive the rest of the 50, where the rest of the 50 would be shown in the financial statements. Any guesses? Anyone could unmute themselves and go.
Accounts receivable.
Perfect. That made me happy. So the accounts receivable is what tells you about like how much money you still need to receive from the consumers, and the income statement is just the total of the accounts receivable plus cash. So you will need to adjust for the accounts receivable here, the accounts payable, and everything non-cash that you did. So you take the net income, you adjust it for non-cash expenses, because the net income includes both cash and non-cash, and that gives you the cash flow from operating activities. And the direct method is you just take the revenues, whatever you earned in cash. So you're ignoring everything non-cash now. So if the revenues were, if you sold revenues of $100, you only got 16 cash. So here, instead of writing 100, you would just write 60. So that's the direct method of calculating the cash flow from operating activities. Just like writing down everything again, but only looking at the cash in the cash expenses and the cash revenues. Okay, but what you should be familiar with or what you should be comfortable with is the indirect method. So the second thing is cash flow from investing. So the investments could be, and again, it could be both cash outflow and inflow. So always when you're talking about cash flow, you should be thinking about both inflows and outflows. So the outflow could be you made some investments in some other company, or you bought some machinery and stuff. So when you say you bought some machinery, that's called capital expenditure. So if you've heard the word capex, that's what that is. Good. All right. And it could be also a cash inflow. So the cash inflow could be you sold off some machinery or some land or something like that, or a part of your business. This is called a divestiture. So that's what the cash inflow is. And then we have cash flow from financing. So the financing is, again, actually a quiz question. So what are the two ways that we can raise capital for a company? I mentioned this like, I think 20 minutes ago.
Debt and equity.
Debt and equity, yeah. So when we talk about financing, we talk about debt and equity. So if you have any long-term debt, so if you have to take on debt, so it'll be a cash inflow. And if you have to pay back debt, that'll be a cash outflow. Someone asked a question. Why isn't selling off a part of your business a financing activity? It's so financing is when you're talking about raising capital for your business. You could also make the argument like, why isn't selling off inventory a financing activity, because you're also like making money out of that as well. But this is like, what the categories are kind of defined by. So when we talk about financing, we're only looking at debt and equity. So raising capital basically, and any investments, because any purchases of assets non-current or any selling of assets which is non-current all go under the investing activity. This is like how it's divided. And why is it like that? It is just because it is how it is laid out in the GAAP principles that I talked about in the very beginning. So equity is like if you issue shares, that's cash inflow. And if you repurchase shares, that's the cash outflow. So what these mean is, so for example, again, my company is divided into 100 parts, each for $1. And I need some money. I need like $10 right now. And I sell off 10 shares of my company to Eric, and Eric gives me $10 in return. But later on, like I know that my company is gonna grow, and I don't really want someone else to actually have 10% of my company. I want to own 100% of my company myself. So I would say like, hey Eric, like would you be willing to sell me off the shares that I actually sold off to you? And if he agrees to to give me back my shares at maybe $5 a share, I would pay that money to him and repurchase the shares. Any questions so far? So for all of these, cash flow is equal to cash inflow minus outflow. So for all of these accounts, you would have cash flow from operating activities, basically, which is all the cash outflows from operating activities minus the inflows from operating activities. I'll give you a number here. Outflow minus inflow. And then, sorry. And you'll have the same here. And you'll have the same here. But again, but of course, we're looking at the cash outflows from financing here and investing there. So when you take the sum of all those three cash flows, you get the total cash flow is equal to CF from operating activities plus CF from investing activities plus CF from financing activities. So this is what the three accounts are. It gives you the total cash flow, and for this year, and then you also have a beginning or last year's cash flow, maybe cash. So maybe you had like $500 of cash from last year, and the total from this year is like 200. It could be both negative and positive, of course, because maybe you made more outflows than inflows. So when you add this plus this, actually it's not a formula. When you add the total cash flow from this year plus last year, it's the total cash, not flow. So the total cash that you would have at the end of this year is what this year's cash flow is, plus any excess cash you had from last year. So that's the three financial statements. Any questions so far? Like any maybe stupid question, or maybe like tell me what maybe ask me like what operating activities are. Like any the question could be anything. I would give you all a chance to kind of take a breather and reflect and see if you have any questions.
So total cash flow is for this 1 year, right?
Yeah.
And then last year's cash we take into account for total cash, right? Only as, but not the one before that. Although that probably last year's cash also include the cash from before the year, right?
Yes.
Okay.
Yes. Any other question?
Free cash flow. Teddy asked, I think.
Sorry, say it again.
What about free cash flow? Teddy asked, I think.
Yeah.
So the free cash flow is so we'll look at free cash flow when we talk about the DCF. But it's essentially EBITDA minus capex, minus any working capital and stuff. Any other question? Anything that didn't make sense, or anything that still you're not too sure about? And if it's something that I've spoken about 10 times, you can ask me the 11th time. It's fine. I'm here to help. Nothing? Okay, so I'll